Imagine two people investing the exact same amount of money. The first person sleeps peacefully every night. The second person checks their phone every few hours, worried because their investment keeps going up and down, yet both of them invested in mutual funds. So why is one person calm while the other is stressed? The answer is simple. Not all mutual funds are the same. Some are designed to protect your money. Others are designed to grow your money aggressively. And choosing the wrong one can leave you frustrated, disappointed, or even tempted to quit investing altogether. In this video, I'll explain exactly what mutual funds are. Let's explore the different types of mutual funds available. We'll cover the safest and riskiest options and how to choose the right ones based on your age, goals, and risk tolerance. By the end of this video, you'll know exactly where you fit. Let's get started. What exactly is a mutual fund? Let's make this simple. Imagine 10,000 people each contribute money into one large basket. Instead of each person trying to invest on their own, professional fund managers take that basket of money and invest it on behalf of everyone. That basket is called a mutual fund. Think of it like hiring a professional driver. Instead of driving yourself through a city you've never visited before, the driver already knows the roads. The fund manager already knows the investment market. A mutual fund may invest in stocks, government bonds, treasury bills, corporate bonds, real estate assets, money market instruments. Depending on the fund's objective, the value of your investment rises or falls based on how those investments perform. Mutual funds have become popular because they solve several problems. First, diversification. Instead of buying one stock, your money can be spread across dozens or even hundreds of investments. Second, professional management. Experts monitor the investments daily. Third, accessibility. You don't need millions to start. Many mutual funds allow relatively small investments. Fourth, convenience. You don't need to constantly watch the market. The fund manager does that for you. But here's what many investors don't realize. The biggest question isn't whether you should invest in a mutual fund. The biggest question is, which type of mutual fund should you choose? Because that's where risk enters the picture. Look, I know what some of you are thinking right now. What if I don't feel comfortable investing through apps like Bamboo or Cowrywise? That's completely understandable.
Investing your hard-earned money is a serious decision, and not everyone wants to start by clicking buttons on a mobile app.
If that's you, you can simply walk into a financial institution that offers mutual funds. It's an easy way to start investing. They'll help you find the right option. For example, Stanbic IBTC Holdings and other investment managers have representatives who can guide you through the entire process, step by step. They will explain the available funds, help you open an investment account, and show you how everything works. After that, you can use their mobile app or online platform to monitor your investments and track your progress. So don't let fear of technology stop you from investing. The important thing is getting started. Now let's take a look at the four main types of mutual funds. Money market funds. These are generally considered the lowest risk mutual funds. They typically invest in treasury bills, bank deposits, commercial papers, short-term government securities. Their main goal is preserving capital while earning modest returns. And some of the benefits of this kinds of investment are lower volatility, which is less risk of sudden drastic drops in price. You usually have easier access to your funds. It is also suitable for emergency savings. But then you may experience lower returns. It may struggle to beat inflation during certain periods. Just think of it as walking slowly, steadily, and predictable. Bond funds invest primarily in government and corporate bonds. Risk is generally higher than money market funds, but lower than stock funds. Some of the benefits of bond fund is that it moderates income. It is more stable than stocks, but bond prices can still fluctuate. Interest rate changes can affect performance. Think of this as riding a bicycle, faster than walking, still reasonably stable. Balanced or mixed funds combine stocks and bonds. The idea is to achieve balance between growth and stability. Some of the benefits of this is diversification, moderate growth potential, and moderate risk. but it is not as safe as money market funds and not as aggressive as stock funds. Think of it as driving a car in comfortable speed and reasonable risk. Equity or stock funds invest mostly in stocks. Historically, they have offered some of the highest long-term growth potential. Some of the benefits are higher long-term returns, better wealth-building potential, but it has higher volatility. Prices can fall sharply during market downturns. Think of it as flying in an airplane. You can reach your destination faster, but turbulence can be uncomfortable. Imagine putting your rent money into a stock fund today. Tomorrow, the market drops 15%. Now you're praying harder than the fund manager. That's why understanding risk matters. Generally speaking, when you think of lowest risk, you think of money market funds, moderate risk, bond funds, medium to higher risk, balanced funds, and highest risk, you think of equity funds. Notice something important. Higher risk does not guarantee higher returns. It only means greater uncertainty. Many beginners hear high returns and stop listening. But experienced investors understand that risk and return are always connected. Now let's discuss age. Not because age determines intelligence, but because age affects time. And time is one of the biggest advantages in investing. In your 20s, you have time on your side. Market downturns can recover over decades. Many younger investors can afford a larger allocation to equity funds. In your 30s and early 40s, you may still seek growth, but responsibilities increase. Family, mortgage, business, school fees. A balanced approach often becomes more appropriate. In your late 40s, 50s, and beyond, preservation of wealth becomes increasingly important. Many investors gradually increase exposure to lower-risk funds. Protecting wealth becomes as important as growing wealth. Now, how do you know your risk tolerance? Ask yourself 3 questions. If your investment drops 20%, what would you do? Sell immediately. Feel uncomfortable but stay invested. Or buy more.
When will you need the money?
6 months, 5 years, or 20 years. Lastly, do market fluctuations keep you awake at night? Your answers reveal a lot about your true risk tolerance. Not the risk level you wish you had. The risk level you can actually handle. The biggest mistake is copying someone else's investment strategy. Your friend may invest aggressively because he won't need the money for 20 years. You may need yours in 2 years. Same mutual fund, different goals, different outcomes. Never choose an investment simply because someone else made money from it. Choose based on your goals, timeline, and risk tolerance. Mutual funds are powerful tools, but they are not magic. The best mutual fund is not necessarily the one with the highest return. It's the one that matches your goals, your timeline, and your ability to handle risk. If you're looking for stability, money market funds may fit. If you're seeking a balance between growth and safety, balanced funds may make sense. If you're investing for the long term and can tolerate market swings, equity funds may be worth considering. What is most important is understanding yourself before choosing the fund, because successful investing isn't just about making money. It's about staying invested long enough for your money to grow. If you found this video useful, hit the like button and subscribe to Finance with Successful Success. Which mutual fund category best matches your current age and risk level? Money market, bond, balanced, or equity fund? Let's discuss it in the comments section.